Good morning, everyone, and thank you for joining us this morning for the June 12th FOMC meeting recap. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenter today by using the chat feature at the bottom of your screen. You can find the chat feature by clicking on those three dots on the bottom of your screen if you're on a mobile device, or chat if you're joining from the computer. Before we begin, I'd like to introduce our economist on the call today, David Widmar, co-founder and managing partner of Agriculture Economic Insights. David was kind enough to glean the information from the meeting yesterday, interpret the data for us, and share his perspective of what yesterday's findings will mean for the overall economy and the farm gate. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. And so with that, thank you all so much for joining us. We will be answering those questions that you submit via the chat on the back end of the webinar. And David, go ahead and take it away.
All right, Micah, thank you so much. Thank you everyone for joining today's discussion and conversation. As you're probably all aware, the FOMC's meeting this month, ended on, sorry, I'm having some computer program issues on my own. So that FOMC meeting wrapped up on Wednesday, and the announcement was no decrease in interest rates after this June meeting. And in fact, they sort of repositioned themselves from their earlier meetings. Of course, back in March was the most notable. And so they also are suggesting and signaling that maybe only 1 or 2 rate cuts are likely in 2024, whereas in March and even as far back as December last year, the summary of economic projections was signaling closer to 3 rate cuts. So we're going to dive into that, and we're going to talk about the implications for the farm, about the macroeconomy more broadly, not just interest rates, but also the implications for you and your operation. So here's sort of the first table that came out of that summary of economic projections. And what is that? A bit of a reminder is there's 19 participants in that FOMC meeting, and they all share their expectations about the economy, such as GDP and inflation and unemployment rates, and then also where they think would be an appropriate path for the federal funds rate, the Fed funds rate. And they submit expectations for the current year, but also 2025, 2026, and then this, theoretical longer run that we never ever get there, but again, it's giving us an idea what the curve of some of these expectations look like. I want to put a little caveat here. This is not something they vote on as a group. This is not something that they reach as sort of a consensus. This is just a summarization of the individual participants' expectations that they submit. So it's kind of like getting around the table and everyone sharing some base level knowledge before they start voting on this policy. And this is really important because I think sometimes we take these projections and the summary of this projection and we turn it into like, oh, the Fed says we're going to have 1 rate cut in 2024. And then if that shifts, we all of a sudden change the narrative, the Fed changed their mind. Well, it's these participants and they're updating their expectations. So again, that's a little bit of a nuance, but worth pointing out. I've highlighted 2 boxes that I think are important to mention and talk about. The first one is their expectations around inflation. You can see back in March for 2024 expectations where inflation would be coming in about 2.4%. They've revised that a little bit higher, up to 2.6%. We're going to talk about some data around that. But as you well know, inflation expectations and inflation data have been creeping higher here in the first half of 2024. As you can see, they still expect back to 2026 that inflation is going to get under control and only a little bit of uptick here in 2025. So maybe a little more persistent in the challenges of getting inflation under control this year, but again, the bulk of that concern is going to ease into 2025 and 2026. The other consideration here is this Fed funds rates. 4.6% was the median expectations for the midpoint of that Fed funds target range. That was representing 3 rate cuts. Of course, now we're at 5.1% from that after this month's meeting, so that represents 1 rate cut. I tried to summarize over here. Sometimes it can be difficult to look across time, look at this curve. Essentially in March, they were saying 3 rate cuts in March, 3 rate cuts in 24, 3 cuts in 25, and 3 cuts in 26. So a total of 9 cuts. What we see in June here is now the median consensus is 1 rate cut in June, 4 cuts in 25, and 4 cuts in 2026. And the total here is still getting us to 9 cuts, or that 3.1% is unchanged for 2026, but we sort of pushed all this back a little bit. We've backloaded that trajectory to more happening in 25 and more happening in 2026. So if we're really hoping for 100 basis points a cut and maybe some of the loans products that we're using, or some of the savings rates that we're following, it's now going to happen a little later in time and not necessarily as soon as we thought back, even in March and December. So let's talk a little bit more about these individual expectations. This is called the dot plot, and this is a summary of the Fed funds rate expectations. I said all 19 participants shared their expectations, and let's start off by focusing on 2024 here. And what I want to point out is 4 participants said there was no change. 7 participants put in 1 cut for their expectations, and 8 participants said there were 2 cuts. Now, there's a lot of ways you can slice and dice this. The median, which I showed you earlier, was so the midpoint of these expectations was for 1 cut. But you can also see that the largest group of respondents were saying 2 cuts. So it's still a bit up in the air. It's still a bit ambiguous around 2024, but I want to really lock in here. There is a range of possible outcomes. So the 19 people whose job is it to watch the economy and contribute to these discussions about what the appropriate Fed funds rate should be, there's not a unanimous consensus amongst them. And to that point, look at how wide the range of expectations are for 2025. One participant sees rates the same into 2025, and there's of course a participant who has this Fed funds rates dipping below 3%. So a huge dramatic shift, and that even those expectations are spread into 2026 and beyond. So what I want you to take away from this is to just keep in mind that some of these summaries about 1 rate cut locked in for 2024, there's a wide range of expectations when we start thinking about the expectations of the individual folks on the committee and the individual voters. And I think we should probably keep a similar range of possible outcomes in our own expectations. We should be thinking about this as how likely. So, what's the probability of this event happening? Well, that's a different set of questions, but you get this range of possible outcomes where maybe there is some possibility here that we have more than 1 rate cut in 2024, but there's also the possibility we have no rate cut, and even into 2025 there could be no rate cuts. I want to talk a little bit about inflation and what's actually going on in the data that the Fed's watching and monitoring. Of course, there was some encouraging inflation data that came out earlier this week while the Fed was having their FOMC meeting, and this was with the CPI index. We're focusing on the PCE index. This data will come out a little bit later in the month. And on the left, this is the chart that you're most likely to see, and as you can see, we're on a bit of a roller coaster here. This was when inflation was really going in early 2022, and then we saw a little bit of an uptick here in the beginning of 2024. This is sort of this year-over-year change, and this is the common way of thinking about it. It's very intuitive. If the year-over-year change is up 3%, we know that prices today are 3% higher than they were a year ago. There's a month-over-month way of looking at this data too, and it's not intuitive because it's like saying, oh, prices are 0.25% higher than they were last month. That doesn't really compute very well in our traditional way of thinking. So sort of don't focus too much on the scale here, but look at the trends. And what I want to point out here is this is what this month-over-month data was telling us. And what the month-over-month data is really good at is it kind of is a bit of it's a bit hypersensitive, but it gives us a really good month-over-month idea of what the latest data are saying and what the trends are. So this is back in the last quarter of 2023. This is whenever everyone was thinking, oh, inflation news is encouraging. We might see 3 rate cuts. And of course, this is kind of this condition where like we're maybe a little bit of concern about the economy stalling, and that could have contributed to the Fed getting aggressive in those rate cuts at the end of 2023 and the first part of 2024. But like Goldilocks, this was probably inflation that was running too cool. close to a 0% change, this is, of course, getting a little bit too warm. And so we saw this in Q1 of 2024. We saw this peak up, and this is what everyone was concerned about, and this is why we hadn't seen these rate cuts into Q2 of 2024. And so we're seeing some encouragement. It's headed back lower, and this is, again, this roller coaster, this ups and downs. But of course, if you really want to think about where the Fed's going to go in the next few months, this month-over-month measure is a pretty good idea. If we start seeing values coming back in closer to zero, these rate cuts start to become more likely. If we see it hang out closer up here, we're going to see it's less likely to get those rate cuts. We were working at AEI to highlight some of these arguments, the arguments for higher inflation or higher interest rates for longer, or maybe lower for sooner. And the idea here is just to sort of lay out the arguments and use this as a roadmap to help you, the listener, think about, what's going to happen down the road. I don't know what the future has in store. My crystal ball isn't that valuable, but we can look for signals. We can look for data to help us navigate that as it unfolds. So the argument that interest rates are going to be higher for longer really center around three arguments. And the first argument is that inflation is stubborn, and that's what we saw here in the first half of 2024. We saw that uptick in inflation. Another argument is that continued government spending spree. Little interest in addressing this, and government spending is another way of fueling the economy. And so if we see strong government spending, that's another way that we could create strong economic activity. We risk overheating the U.S. economy. And the third argument is that we have this tight labor market, and that could spill over into higher wages. And so the idea here is we're going to have a lot of wage pressure, and this wage pressure will work its way into more spending and on the inflationary side. The lower for sooner argument is that there is this continued low productivity growth. This is sort of a long-term trend, slow economic growth in the U.S. economy. Generally speaking, economies with lower rates of growth have lower interest rates. And so we'll eventually get through this pandemic ups and downs, and we'll eventually get back to our norm of sort of a slow economic growth, meaning low interest rates. U.S. government debt is still preferred as a safe asset. So those around the world are still going to be investing in U.S. debt, and so that spending issue wouldn't be quite as a problem. There are demographic shifts, so slow declining population growth, longer lifespans, both in the U.S. and globally, and then also the looming threat of a recession. So the idea here is this is a bit of a scorecard. Take this, print it off, put it on your wall, share this with the coffee shop, share it with your peer group of advisors, and think about which one of these arguments is sort of winning the argument of the week or the month or the quarter or the year. And this is going to give us an idea which direction the Fed's going to be leaning towards when it comes to their decisions. As you can see here in the last part of last several months, the last quarter, this inflation remaining stubborn, that's been the one that's been on center focus. But as we move forward, some of these other arguments on the right could start to creep up. One of the things that came up from this conversation that Jay Powell had with reporters afterwards is that the labor market is tight, but it's starting to get back into balance. And so I think that's starting to maybe take this particular argument is starting to come off the table a little bit. And so that is going to be one thing that the Fed's going to be watching that might give them some motivation to move rates lower. I also want to mention here, I feel like it's really, really important. We get hyper-focused. I get hyper-focused on the Fed's next decision, but it's also long-term interest rates are something that producers and farmers and ranchers are often more susceptible to. So in the red is a measure of sort of short-term interest rates, shorter dated rates. And so these are the return on U.S. Treasury securities that are maturing in 1 year. In the blue are 10-year treasuries. And as you can see, since 2022, we've had this inverted yield curve. And the thing that I really want to point out here is that even if the Fed were to lower rates 25 basis points or 50 basis points in 2024, and we talk about maybe more cuts into 2025, what does it look like? What does this yield curve look like, and how does that impact the borrowing costs that individual producers might be facing? So what's the normal relationship? What's this normal yield curve look like? 2010 to 2018 gives us a glimpse. These inverted yield curves, while it's persisted for a couple of years now, this is not what we'd expect to happen in sort of the long run. And so do we get to a norm where, these long-term rates trend higher despite the Fed funds rates being only slightly lower? Or do we see a situation where the Fed funds rates drop a lot and 10-year treasuries maybe are slower to decrease? The point here is there's going to be a bit of a disconnect between what happens at the Fed and the Fed funds rates and what happens on these long-dated loans, these long-dated maturities, these long-dated interest rates that we might be more used to thinking about and using on our operations. One other point here that I want to talk about before we switch to other macroeconomic issues is the Federal Reserve's balance sheet. This didn't get talked a whole lot about. It happened more in May, but there's another way that the Fed has been. It's kind of their secret weapon here. They were able to expand the balance sheet during the financial crisis, the global financial crisis in 08, and then of course quantitative easing, and they expanded their balance sheets dramatically in the early parts of the pandemic and in the years following. But in 2023, they suggested they're going to start to taper. And when they taper this balance sheet, they're going to be net selling these bonds that they had been purchasing. And so it has a way of also adding to the debt situation. And it's a way of slowing down the economy, like their efforts to raise or lower the Fed funds rate. This is another way. So when they're expanding the balance sheets, they're accommodating the economy. When they're contracting their balance sheets, they're tightening on the economy. And of course, if you're worried about the economy overheating, they could be selling these assets, and this is a way of cooling off the economy. And so the orange line represents their projected path in their May 2022 plan. As you can see, there's a little bit of deviation. There's a new product that came out after some hiccups a year ago, but they've been trending on this general path. It's been consistent. But in May 2024, they announced they're going to shrink the balance sheet at a little bit different rate, at a slower rate. And so this is going to start to ease some of the monetary pressure that the economy has been facing. Now, I want to shift gears and talk a little bit about exchange rates here in the next few minutes before we get to all your questions. Exchange rates have been, an important part. I think the reason why exchange rates are important is when you start to see big changes in inflation or interest rates, it's going to start to impact how global investors are thinking about the investments that a country is offering or the value of a currency. And so if we start to see big shifts in the macroeconomy outlook for the U.S., it starts to signal some shifts in the exchange rates. And why exchange rates are important is that international buyers of ag goods, ag exports, have to first buy U.S. dollars. So they take local currency, they buy U.S. dollars, and then they can buy soybeans or corn or beef. And if the dollar is strong, and I think strong and weak currency is a bit of a confusing way of thinking about this, it conveys that an expensive dollar is good and a cheap dollar is bad, strong and weak. But if we think about this as expensive or cheap, or expensive and not expensive, this is a better way of thinking about it. So when the dollar has been strengthening, which we've seen back since 2021, a general upward trend, this means it's getting more expensive for international buyers to buy US dollars to then buy our goods and services. Of course, the other way of looking at this is a strong dollar means there's a lot of confidence in the U.S. economy. There's a lot of confidence relative to the other countries. The U.S. dollar is seen as a good place to store money. Now, let's break this down. Unfortunately, that broad measure is the one you're most likely to see when you're reading the paper or on social media, but there's a lot of details, a lot of nuances. So I want to focus on a couple of them. The first one is advanced economies, such as the European Union. This is blue, or maybe Australia, for example. This is the US dollar versus advanced economies and versus emerging economies. And the thing I want to point out here is that what's happened in the last few months is that the US dollar versus emerging economies, maybe like Mexico or our soybean competitor in South America, is the dollar's picked up quite a bit of strength in the last several weeks. So that's going to be important to keep in mind. So it's not just the dollar strengthening overall, it's who the dollar is strengthening relative to. Now, part of it could be it's all relative, right? So I said, there is relative, earlier I said there's a relative appeal in the US dollar versus other situations. Well, it's not necessarily the case that the US dollar got better or the U.S. economy got better. It's good that other economies could have a less optimistic outlook. So again, it's all relative and it's hard to say what's specifically driving it, but keep in mind that this dollar is really strengthened versus emerging market economies. And I want to give an example here. This is the Mexican peso to the US dollar. And I took some notes here. At the end of May, it was 16.7 pesos for one US dollar. And here, at the end of last week, so in just 2 weeks, it jumped from 16.7 at the end of May to 18.3. So that's $1.50 more, 1.5 more pesos to buy a US dollar. And we think about uh, the purchasing power of a Mexican peso to buy U.S. corn, that got cut significantly just in the last few weeks. So that's what we want to keep an eye on moving forward. It's these emerging markets that are really struggling, and Mexico is one of the examples. We took a look at this at the commodity level, the USDS and grade data on this. And so we talked about earlier, the dollar varies by country, but it also varies by commodities. So who are our trade partners? And this is a look at this index. We've anchored it to 2020. So you can see that the dollar is about 10% higher for all ag exports. Bulk ag exports, so corn, wheat, soybean bushels, it's faced about a 13% increase. But look at soybeans. Soybeans have been one of the hardest hit ag commodities. We've really faced a big uptick in the exchange rate pressure that the U.S. soybeans have faced. And so when we think about this, always pause and say, what countries is the U.S. dollar stronger or weaker relative to? Where's this pressure really coming from? And then what commodities are being impacted the most? And unfortunately, it's been soybeans here heading into 2024. I want to talk a little about the timeline that you can think about for the next several months. There is a meeting at the FOMC at the end of July. There's another meeting in September. And then there's the U.S. elections on the 5th of November. And then immediately following the elections on the 6th and the 7th, there's an FOMC meeting. And then there is their December FOMC meeting. We'll have another one of these breakdowns at the end of September and December. That's when they release those summary of economic projections. This is whenever, as an economist, we can really dive into the data a little bit. But as you can see, there's 4 opportunities for them to update their expectations, update their thinking, and also make some decisions on the rate cuts. Right now, the consensus is that the Fed's going to be making a move. They're going to lower rates. It might be at this September meeting that they could start to be looking at this. Of course, there will be another inflation data point that happens before this July meeting. So maybe there's enough data in here. But the idea here is we have seen some encouraging news on inflation, especially with the June release, but it's probably going to take a couple more months of data before they feel the confidence that the inflation is coming into the right direction. I want to wrap it up here and open up for all your questions. The economic outlook for the economy, the U.S. economy is still favorable. One of the quickest ways that we can see the Fed lower interest rates is if the U.S. economy enters a recession. And despite all the predictions, this just hasn't materialized. This is, I think, a positive development, but the strong U.S. economy is one of the reasons why we've seen the Fed being able to keep rates this high for so long. 1 or 2 rate cuts is now expected for 2024, but keep in mind the Fed is shrinking their balance sheets. That's going to kick in any day now, and in that shrinking at a slower rate, I should clarify, that's shrinking at a slower rate. This is going to be a way of easing some of the braking they had on the economy. Key to monitor moving forward, we mentioned these last time, and it's going to be important again, inflation and unemployment. If we see these start to move, and these are the Fed's dual mandates, if we see these really move in a dramatic way, the Fed's going to have to step up and respond accordingly. And ultimately, the unknown that we're really monitoring is where do those long-term rates go? How does this Fed's decision impact the yield on long-term interest rates? So that's all I have for this conversation. I'm looking forward to all your questions that you've been submitting along the way.
Thank you, David. The first one that I want to address here was on submitted via the registration process, and that was, is the political change maybe going to impact interest in the coming months?
Yeah, I think there's a lot of ways to think about that question. I think the Fed is trying to be cognizant and cautious of the elections. They don't want to seem political. And so I think that's one of the reasons why there was some expectation, especially in the beginning of the year, that they might be making rate cuts about this time, and then they might step away and not make rate cuts in Q3 to avoid this this election process, and then they might be able to come in after the election in the November and December meetings. I think it's also one of the reasons why the Fed has been telegraphing the expectations. Now, it's kind of interesting to think about, what party would the Jay Powell, the FOMC chair, align with? He was appointed by President Trump. He was reappointed by Joe Biden. Donald Trump wanted to fire him at one point during his administration for the Fed tightening on the economy. Trump has said that he would not reappoint Jay Powell for another appointment if he was the president. So the FOMC chair is the off cycle of the election. So he was appointed in 18, reappointed in 2022, would be up for reappointment again in 2026. I think right now the neither party would want to claim the Federal Reserve is aligning with them, and I think that's probably a good spot for the FOMC to stick at. One of the things I will also mention here is keep in mind that political spending is another way that you could fuel or cool the economy. And I think another key point to think about is the Federal Reserve has made 2% their target for the long run goal for inflation. And so they're going to keep raising inflation, keep interest rates high until inflation gets back to that 2%. There could be a little bit of a political debate. Is 2% the right number? Or is 2.2% or 2.4% or 2.5%? You can imagine this slippery slope as to what's the appropriate measure for inflation. And so you can see some political posturing around, hey, we want the Fed to stop this thing at 2.5% inflation. If we get there, then we can lower interest rates and maybe we can keep the economy humming along and we can keep full employment. I think that could be a bit of a political debate as to is 2% PCE the appropriate measure.
And that kind of leads us into our next, maybe more on perception. So how much risk do you think there is in the private credit market currently?
Yeah, that's a great question. It's one of the challenges we sort of lived through, that risk that was going on in the shadow lending side of things during the great financial setback of 08, 09. I think is always a bit of an unknown. I think one of the reasons why that's a bigger concern today is that when we have these really low interest rates, so we can all agree that high interest rates are distortive, but low interest rates are also distortive. And one of the distortive features of low interest rates is that folks are going to take on more risk to get a similar rate of return. They're going to move their way up that risk curve. And so there could be a lot of risk out there in that private credit market because they were pursuing those high returns and they needed to take on more risk. I think another thing that is worth keeping in mind for listeners today is that we had a bit of a credit freeze after that 08, 09 housing crisis and the financial recession that associated with that. And one of the reasons is because those that were in business of lending money, sort of these private lenders that weren't a traditional lending institution, they got scared and they stopped lending money. And so there wasn't enough money in the market for the lending activities. And so one thing that's going on in agriculture is there's a lot of folks who are providing credit in lending terms when that's not their core business. And so when things get tight and things get lean, we historically see non-traditional lenders be the first ones to pull back or pull out of the lending operations. And so I think that's one of the risks that the FOMC is thinking about the broader economy, but it could also have some implications for the ag economy. Is that if we had a lot of concerns about the credit worthiness of some of these loans out there, it's these non-traditional lenders that are whose core business is not lending money, it's making goods and services. They could say, hey, I don't want to lend money anymore, I want to get out of this, and that could be less credit available for the market and for the farmers out there relying on that credit.
Let's shift gears a little bit. We've got a topic coming up in August that I want to highlight to everybody based on this question, but where are land prices headed in 2025 and beyond if rates stay the same or move higher? And so before you hop in, David, we've got a webinar in August coming up, I do believe, where we're going to bring our collateral team alongside David and Brent and kind of talk about What does this mean for the latest farmland values? So that event is going to be on August 22nd, and we'd love for you all to join us for where we can spend a full 30 minutes kind of digging into this topic.
Yeah, it'll be a feat to get us to wrestle that down to just 30 minutes. So stay tuned for all of the slide edits that are going to have to take place to make that 30-minute time goal happen. But one of the things that we have been seeing in the Purdue survey out of Indiana, it's a really great data set. Not all the listeners today are in Indiana, but that data set I think is regionally applicable, and it's got some unique features, including it captures farmland values, cash rental rates, quality, and it goes back a long time. And so what we can look at is that relationship between rental rates or the earnings that farm can generate and the values. And what we have seen last year is really low capitalization rates, or this rent to farmland value ratio was really low relative to the 10-year treasuries. Historically, 10-year treasuries and that cash rent to value ratio have trended very, very closely. But as 10-year treasuries have headed up, that cap rate has remained low. So we're going to see where that unfolded and where the latest data are saying that's at. And we're going to think about the implications of that. I don't think that farmland capitalization rates have caught up to 10-year treasuries yet. Some of this could be the expectation that rates will be lower. Some of this could be the expectation of higher cash rental rates in the future. But we'll keep an eye on this and we'll break that down. But it's that relationship between rental rates and the value of the farmland that's been low. And we would expect it to go up, but we just haven't seen it quite yet.
David, you spent quite a bit of time on a podcast around kind of the farm credit system, if you will, and this question just rolled in, and I'd like to get an outside perspective. It says, my question was in relation to the farm credit used to determine interest rates on line of credits and long-term real estate, maybe versus what traditional banks use to determine that. So I wanted to give you an opportunity to maybe highlight that podcast and talk through that if you'd like real quick.
Yeah, so the AEI.ag Presents has 3 seasons of a deep dive, and the third season is Nothing Borrowed, Nothing Gained. And we sort of, rather than focus on where interest rates are going to go, we want to step back and say, how do farm loans work? It's one thing to sort of borrow money from a traditional bank or from a farm credit association or another non-lending institution like a retailer or a manufacturer of inputs. But how does that really work? And so I encourage you to take a listen and dive into that. There's about 10 episodes, about 45 minutes apiece. Again, AEI.ag Presents is what you're going to want to search on Spotify or Apple Podcasts, and then season 3, Nothing Borrowed, Nothing Gained. And I'll just tell you this right up front. That slide that we were talking about with the inverted yield curve, that makes it really hard to price. It makes it much more difficult to price loans. And so it's a very tricky situation. And so if there's a traditional rule of thumb that we expect, lines of credit to be at this level and real estate loans to be at a slightly higher level because there's more time associated with it, this inverted yield curve is messing up these relationships. One of the things that we tried to share is that inflation creates pain in the economy because it messes up relative prices. And we have relative prices for loans are a little bit messed up in this environment. The other thing I'll add is that the farm credit system acquires its funding very differently. It's going out to the bond markets. And so the traditional rule of thumb is that those rates adjust more quickly, and where traditional lenders have a different set of resources, a different set of pools. Sometimes those loans eventually make their way to the bond markets through Farmer Mac, for example, relative to agriculture. But there's often there's maybe some lag between those traditional deposits, a CD or a savings account that traditional lenders might be using. But yep, take a look at that season, and there's a couple episodes that you'll find particularly valuable and of interest.
David, one of the things that I always like to talk about with customers when this kind of question comes up is that the farm credit system is truly the only banking institution where we go to Wall Street and take Wall Street money and infuse it into the rural communities that we serve. And so that happens throughout the entire farm credit system through our funding banks who are spending time on Wall Street and purchasing and selling those bonds. And so that's how we get our funds to be able to continue to secure the future of rural communities and agriculture. So I think that's a good one to end us up here. And we are 6 minutes over time. So I do appreciate you all for joining. This was recorded and we will send the recording out for your reference following the meeting. So thank you all so much. David, thank you for your time. And we look forward to talking to you next time.
Thanks, everyone.